What is international flow of funds? International flow of funds are cross-border investment in domestic equity and bond instruments by global funds, including mutual funds, exchange-traded funds, closed-end funds, insurance-linked funds, and hedge funds. Multinational corporations are heavily engaged in international business, such as exporting, importing, or direct foreign investment in foreign countries. The transaction arising from international business cause money flows from one country to another.
The balance of payments or BOP is a record of all payments or monetary transactions between a particular country and other nations during a specific time period. It provides a useful glimpse into the economic relationships between different countries around the world. The balance of payments account is broken down into three various components. The current account. It includes any exchange of finished goods and services, such as tourism for consumption purposes. For example, when a publishing company in the United States sells textbooks to a university bookstore in Ireland, the payments made to are recorded as a credit to publishing company in US BOP and a debit to university bookstore in Ireland BOP account. The capital account. It tracks movement of capital going in and out of the country for investment purposes. When a university bookstore migrates on publishing company, the items of value he moves into the US within it represented credit to publishing company account and a debit to university bookstores account. Lastly, the financial account. It records payment flows related to the change of ownership in international financial assets and liabilities, where the flows include direct investment, portfolio investment, and reserve assets. In example, which are purchased and sold only by monetary authorities when a publishing company in US invests in foreign securities from a university bookstore in Ireland. This affects a debit to publishing company BOP and a credit to university bookstore BOP account. A country's BOP should be zero, that is the current account, should balance with the capital account plus the financial accounts. However, statistical discrepancies, differences in accounting practices, and exchange rate fluctuations mean that this really happens. One major benefit of the balance of payments is that it allows a country to identify any long-term trends that could be troublesome to its economy by understanding its balance of payments, and the one has the potential to create policies that will put it on the right track.
The growth which represents a rise of about $250 million relative to Q4 2021 is fueled by rising commodity prices as trade volumes have increased to a much lower extent. To expected to remain positive, trade growth has continued to slow during second quarter 2022. It adds that rising interest rates and the winding down of economic stimulus packages likely having negative impact on trade volumes for the rest of 2022. Volatility in commodity prices and geopolitical factors will also continue to make trade developments uncertain. According to UNCTAD's Global Trade Update, the growth of world trade is calculated as the arithmetic mean of the growth of world import volumes and world export volumes. International trade is the purchase and sale of goods and services by companies in different countries. Consumer goods, raw materials, food, and machinery are all bought and sold in the international marketplace.
Impact of outsourcing on trade. Outsourcing means the process of subcontracting to a third party. This definition states that the outsourcing causes multinational corporation to now buy goods or services from another nation, which boosts international trade activity. Outsourcing allows multinational corporations to conduct operation at lower cost. Many multinationals argue that they cannot compete globally without outsourcing some of their production or services. Outsourcing by multinational corporations has created many jobs in countries where wages are low. Here are the factors affecting international trade flow. Number 1. Cost of labor. Firms in countries where labor costs are low typically have an advantage when competing globally, especially in labor-intensive industries. Number 2. Inflation. If a country's inflation rate increases relative to the countries with which it trades, then its current account should decrease, other things being equal. Number 3. National income. If a country income level increases by a higher percentage than those of other countries, then its current account should decrease and other things being equal. Number 4. Credit conditions. Credit conditions tend to tighten when economic conditions weaken because corporations are then less able to repay debt. As multinational corporations reduce their spending, they also reduce their demand for imported supplies. The result is a decline in international trade flows. Multinational corporations that purchase imports rely on letters of credit, which are issued by commercial banks on behalf of the importers and consist of a promise to pay payment upon delivery of imports. Number 5. Government policies. Government policies can have major influence on which firms within an industry attain the most market share worldwide. These policies affect the legislating countries' unemployment level, income level, and economic growth. Here are the government policies. Number 1. Restriction on imports. Number 2. Subsidies for exporters. Number 3. Restriction on piracy. Number 4. Environmental laws. Number 5. Labor laws. Number 6. Business law. 7. Tax breaks. 8. Country trade requirements. 9. Government ownership or subsidies. 10. Policies to punish country governments.
Factors affecting direct foreign investment. First, changes in restrictions. During the 1990s, many countries lowered direct foreign investment restrictions, resulting in more direct foreign investment in those countries. Many United States-based multinational corporations have expanded into less developed countries such as Argentina, Chile, China, Hungary, India, and Mexico. Since government barriers were removed, new opportunities have emerged in these countries. Second factor is privatization. Several national governments have recently privatized or sold some of their operations to corporations and other investors. Privatization is popular in Brazil and Mexico, as well as in Eastern European countries like Poland, Hungary, and Caribbean territories like the Virgin Islands. Because foreign firms can buy operations sold by national government, it allows for more international trade. The primary reason that a firm's market value may rise in response to privatization is the anticipated improvement in profitability. Managers in a privately owned firm can focus on maximizing shareholders' wealth, whereas managers in a state-owned firm must consider the economic and social implications of any decision. Third factor is potential economic growth. Countries with greater economic growth potentially are more likely to attract direct foreign investment because firms recognize the opportunity to capitalize on that growth by expanding their operations. Tax rates as the fourth factor. Countries with relatively low corporate tax rates are more likely to attract direct foreign investment. Firms estimate the after-tax cash flow that they expect to earn when accessing the feasibility of direct foreign investment. The last factor that affecting the direct foreign investment is exchange rate. In nations where the local currency is anticipated to gain value relatively to the target currency, corporations often prefer to pursue direct foreign investments. Under these circumstances, they can invest money to start up activities in a nation where the local currency is reasonably priced or weak. After then, profit from the new operation will need to be exchanged at a least favorable. Again, these are the factors affecting direct foreign investments.
Agencies that facilitate international flow of funds. Number 1. International Monetary Fund to promote cooperation among countries on international monetary issues, promote stability on exchange rates, provide temporary funds to member countries attempting to correct imbalances of international payments, promote free mobility of capital funds across countries, promote free trade. Number 2, World Bank. The International Bank for Reconstruction and Development, or IBRD, also referred to as World Bank, its primary objective is to make loans to countries in order to reduce poverty and enhance economic development. Because the World Bank provides only a small portion of financing needed by developing countries, it has attempted to spread its funds by entering into co-financing agreements. Co-financing is performed in the following ways. Official aid agencies. Development agencies may join the World Bank in financing development projects in low-income countries. Export credit agencies. The World Bank co-finances some capital-intensive projects that are also financed through export credit agencies. Commercial banks. The World Bank has joined with commercial banks to promote financing for private sector development. Number 3. World Trade Organization. This organization was established to provide a forum for multilateral trade negotiations and to settle trade disputes related to the GATT. World trade agreements have been signed among countries, and these agreements provide the legal foundation for facilitating international trade. Number 4. International Financing Corporation, or the IFC, is the largest global development institution focused on the private sector in developing countries. Number 5. International Development Association. It is a loan policy is more appropriate for less prosperous nations. The IDA extends a loan interest rate to poor nations that cannot qualify for loans from the World Bank. Number 6. Bank of International Settlements attempts to facilitate cooperation among countries with regard to international transactions. 7. The Organization for Economic Cooperation and Development, or the OECD. It facilitates governance in government and corporations of countries with market economies. Number 8. Regional Development Agencies. This is objective relating to economic development are more regional than global. The advantages and disadvantages of international flow of funds. Increased aggregate demand, increased production capacity, technological advancement, the surplus on the financial account of the balance of payment, easy finances, the inflow of foreign currencies. The disadvantage of international flow of funds are the loss to domestic players, tax evasions, destroying the real estate market, and the money laundering. Therefore, we conclude the importance of international flow of funds are to increase economic development in terms of foreign exchange earnings, market expansion and increase in competition, increase in local and foreign investments, increase national income and employment, and lower production costs.